The candlesticks are used to identify trading patterns that help technical analysts set up their trades. These candlestick patterns are used for predicting the future direction of the price movements. The candlestick patterns are formed by grouping two or more candlesticks in a certain way. Sometimes powerful signals can also be given by just one candlestick. In this blog, we will discuss all 35 powerful candlestick patterns. But before that, let us discuss how to read candlestick charts. How to read candlestick charts. Candlestick charts were originated in Japan over 100 years before the West had developed the bar charts and point and figure charts. In the 1700s, a Japanese man known as Homa discovered that as there was a link between price and the supply and demand of rice, the markets also were strongly influenced by the emotions of traders. A daily candlestick chart shows the security's open, high, low, and close price for the day. The candlestick's wide or rectangle part is called the real body, which shows the link between opening and closing prices. This real body shows the price range between the open and close of that day's trading. When the real body is filled, black or red, then it means that the close is lower than the open and is known as the bearish candle. It shows that the price is opened, the bears push the prices down and closed lower than the opening price. If the real body is empty, white or green, then it means that the close was higher than the open, known as the bullish candle. It shows that the price is opened, the bulls pushed the prices up and closed higher than the opening price. The thin vertical lines above and below the real body is known as the wicks or shadows, which represents the high and low prices of the trading session. 35 types of candlestick patterns. The candlestick patterns can be divided into continuation patterns, bullish reversal patterns, bearish reversal patterns. Below is the list of 35 types of candlestick patterns, which is categorized in the above categories. Bullish reversal candlestick patterns. Bullish reversal candlestick patterns indicate that the ongoing downtrend is going to reverse to an uptrend. Thus, the traders should be cautious about their short positions when the bullish reversal candlestick chart patterns are formed. Below are the different types of bullish reversal candlestick patterns. 1. Hammer. Hammer is a single candlestick pattern that is formed at the end of a downtrend and signals a bullish reversal. The real body of this candle is small and is located at the top with a lower shadow, which should be more than twice the real body. This candlestick chart pattern has no or little upper shadow. The psychology behind this candle formation is that the price is opened, and sellers pushed down the prices. Suddenly the buyers came into the market and pushed the prices up and closed the trading session more than the opening price. This resulted in the formation of bullish pattern and signifies that buyers are back in the market and downtrend may end. Traders can enter a long position if next day a bullish candle is formed and can place a stop loss at the low of hammer. Below is an example of hammer candlestick pattern. 2. Piercing pattern. Piercing pattern is a multiple candlestick chart pattern formed after a downtrend indicating a bullish reversal. Two candles form it, the first candle being a bearish candle, which indicates the continuation of the downtrend. The second candle is a bullish candle, which opens the gap down but closes more than 50% of the real body of the previous candle, which shows that the bulls are back in the market and a bullish reversal is going to take place. Traders can enter a long position if the next day a bullish candle is formed and can place a stop loss at the low of the second candle. Below is an example of a piercing candlestick pattern. 3. Bullish engulfing. Bullish engulfing is a multiple candlestick chart pattern that is formed after a downtrend indicating a bullish reversal. It is formed